If you look at Thursday and that explosive move that we had, and that was all because we thought that maybe we were going to see some sort of a resolution, or at least talks about a resolution.
With China.
With China.
Right.
So that, I think, is the thing that's weighing the most on the markets. But also, its international growth is definitely slowing, and you do have this Fed worry. On the other side, you have amazing earnings, 25% growth in earnings, and also it's also strong top-line growth, too. We're seeing 8-9% revenue growth too, so it's not just manufactured earnings kind of thing, and the economy is really good. I mean, those numbers on Friday were tremendous. The jobs numbers and the wage numbers are also starting to creep
I thought
higher.
the same thing. Even with a little hotter than expected average hourly wage gains, you didn't see the market pull back on that, as if there was some concern that the Fed might be stepping in.
No, because also the core PCE is very tame at 1.97, rounded up to 2%. It's still very much under control. And I think at the same time, Becky, all of these things are happening, but you're at a multiple in the market at 14.9 times forward estimates, down from almost 20 times in the beginning of the year. So I really think that we're absorbing a lot of this bad news, and a lot of bad news is into the stock market. And I'm looking at strong fundamentals, and I'm actually picking away at the strong fundamentals.
Barry, what do you think?
I think Steph had a number of really excellent points. I would agree from a corporate fundamental perspective that the story here is not earnings growth, it's revenue growth, right? So for most of this business cycle, nominal GDP plus inflation grew less than 4. It's been above 5 now for 8 quarters. That's driven, it's roughly, revenue growth should be similar to that. Revenue growth has been averaging 7 or 8 now for 2 years. I think it'll continue well into 2019. And so this idea that, well, earnings are going to really decelerate to something like 7%, not at 6 or 7% revenue growth, because you still have operating leverage at that level. So it'll be more like 12.5, which is really what happens typically in the middle of the cycle.
But if you do see, let's just say we do see earnings slow to 6, 7, 8% growth. If that's the case, is that a reason for stocks to be trading down here at 15 times forward earnings?
I don't really get too caught up in a given level of earnings growth for a given valuation metric. Valuation tends to rise through the business cycle, and the mean reversion mechanism is actually a recession, right? And so the only way that 14.9 times forward earnings makes sense is if the recession is within a year maximum. And I just don't believe that's the case. Actually, the best thing I heard about that recently was on your show, one of my old colleagues, Drew Mattis, who said the reason that everyone keeps forecasting it 18 months out is because that's as far as they can forecast. So they just keep saying, well, it's at least 18 months out. There's no evidence of that. And a couple of other...
There's no evidence that an economic...
That we're about to have a recession.
Right.
You also touched on a really important point about the wage growth. So there's 2 things that can drive wage growth higher. One is scarce labor resources, right? A low unemployment rate. But the other is that you get a big pickup in turnover, labor market dynamism. And that's actually what is working and what is really driving wage growth up. So we've had, we had a really tepid recovery in the turnover in the labor market until 14. Then it jumped. It backed up in 16. It's really moving higher. So if you think about the implications of that, if people get jobs they want, productivity goes up. If you just have to hire workers that are suboptimal, productivity goes down. And that's actually the turnover models are what's driving wages.
Well, we have heard anecdotally stories of people saying, forget it, we're not doing drug tests anymore because we can't find enough qualified employees if we actually put drug tests.
You can find lots of anecdotes for everything. This is like the anecdotes that trade is impairing industrial sector margins, except that industrial sector revenues are up 9 and earnings are up 22. So I don't know where the impairment's coming in, and margins are still going up. But same thing with that. So we had built 2 big models, one based on slack and one based on turnover. And the one that's actually predicting wages is the one based on turnover. So that's really the driver here, and it's non-inflationary.